How safe is Chevron Corporation's dividend? On August 2, 2019, Chevron Corporation reported second quarter results for the period ending June 30, 2019. This video provides an update on the company's dividend safety using its most recent operating results. To begin, let's talk about Chevron's business model. Chevron is one of the world's largest oil companies. The company is engaged in upstream oil and gas production, as well as operates a downstream refining business. Chevron has a market capitalization of $230 billion, with annual revenues of nearly $176 billion. Chevron is one of the world's most popular dividend growth stocks. The company's current dividend yield is 3.9%. Moreover, Chevron is a consistent dividend grower. In fact, the company has increased its annual dividend payment for 32 consecutive years. Because of this, Chevron qualifies to be a member of the Dividend Aristocrats, an exclusive group of dividend stocks with more than 25 years of consecutive dividend increases. Looking ahead, investors interested in owning Chevron stock will likely be interested in the safety of the company's dividend payment. For the remainder of this video, we will discuss Chevron's dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. Chevron's dividend safety relative to earnings. First, let's discuss Chevron's dividend safety in the context of the company's current earnings. In the second quarter of fiscal 2019, Chevron generated adjusted earnings per share of $1.77, which compared unfavorably to the $1.78 of adjusted earnings per share in the same period a year ago. For context, Chevron currently paid a quarterly dividend of $1.19 per share, which implies a payout ratio of 67% in the most recent quarter. Looking out over a longer time horizon, the payout ratio is slightly higher, but still considered safe. Chevron generated $3.24 of adjusted earnings per share in the first half of fiscal 2019. The company distributed $2.38 of common share dividends during the same period for a dividend payout ratio of 73% in the full fiscal year. Using earnings, Chevron's dividend appears very safe for the foreseeable future. Chevron's dividend safety relative to free cash flow. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Chevron's current dividend payment to its free cash flow. Chevron generated $8.7 billion of cash flow from operating activities in the first quarter of fiscal 2019 and spent $3.5 billion on capital expenditures during the same time period for free cash flow of approximately $5.2 billion. The company distributed $2.3 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 44%. Looking out over a longer time horizon, the payout ratio is slightly higher. Chevron generated $13.8 billion of cash flow from operating activities in the first half of fiscal 2019 and spent $6.5 billion on capital expenditures for free cash flow of $7.3 billion. The company distributed $4.5 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 62%. Using free cash flow, our conclusion for Chevron's dividend safety is the same as when we used earnings. The company's dividend is currently well covered by free cash flow, and we see no risk of a dividend cut in the near future. Chevron's dividend safety relative to recession performance. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Chevron's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Chevron's performance during this time period is shown here. 2007 adjusted earnings per share, $8.77. 2008 adjusted earnings per share, $11.67. 2009 adjusted earnings per share, $5.24. 2010 adjusted earnings per share, $9.48. 2011 adjusted earnings per share, $13.44. 2012 adjusted earnings per share, $13.32. 2013 adjusted earnings per share, $11.09. Chevron's adjusted earnings per share fell 40% during the last recession. Adjusted earnings per share declined by 55% in 2009 alone. The company did not make a new high in adjusted earnings per share until 2011. More importantly, though, the company's earnings still covered its dividend payment, and Chevron continued its multi-decade streak of dividend increases. Because of this, we have little concerns about the company's ability to pay rising dividends during future economic downturns. Chevron's dividend safety relative to its current debt load. The last angle that we use to assess Chevron's current dividend safety is by looking at the company's current debt level, which is a cause of concern for many investors. More specifically, we will see how much the company's weighted average interest would have to increase before its free cash flow would no longer cover its dividend payment. At the end of the second quarter of fiscal 2019, Chevron had $30.6 billion of total debt outstanding. The company generated $198 million in interest expense in the most recent quarter for a weighted average interest rate of 2.6%. The following image shows how changes to Chevron's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As you can see, Chevron's weighted average interest rate would need to rise above the 21.5% level before its dividend would no longer be covered by free cash flow. Because of this, we have little concerns about the impact of the company's debt on Chevron's dividend safety moving forward. Looking out over a longer time horizon, our conclusion is the same. Chevron generated $423 million in interest expense over the first half of fiscal 2019 for a weighted average interest rate of 2.8%. The following image shows how changes to Chevron's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As you can see, Chevron's weighted average interest rate would need to rise above the 21% level before its dividend would no longer be covered by free cash flow. Because of this, we have little concerns about the impact of the company's debt on Chevron's dividend safety moving forward. In conclusion, thank you for watching today's video, which performed a deep dive on Chevron's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website, suredividend.com.